Hello, guys. This is another episode of Finally Friday. So, I'm going to wish you all a good weekend and a relaxing weekend, and I hope all is well, and I hope your trading week was all right. So, we're going to talk today about you as a trader versus Wall Street. There is a narrative that's being promoted by certain traders on social media and on forums of the self-directed trader versus Wall Street. And I think it causes lack of risk management, and I think it could affect you psychologically when you trade. And let me explain what it is. Basically, there is this promotion that if you get caught in a position that goes against you, you should not give up, right? And they start throwing those things such as diamond hands. They're usually involved with emojis. And they tell you shouldn't get out of the position because it will come back and you'll make your money back if it goes against you and so forth. So that's a really bad risk management skill to adapt as a trader. That's number one. Second of all your decisions should be individual. And this should not be done as a part of a group effort on a certain opinion. But I'm here to explain to you something much larger than that. Why the narrative should never be you against Wall Street. Look, it's not that I'm a big fan of Wall Street, but they truly have nothing to do with you as a trader. Absolutely nothing. Your decision should be your independent decisions, and they should pertain to your specific situation in the asset class that you are trading. And just remember one thing, and this is something that you have to keep in mind. As a self-directed trader, you have a lot more flexibility than a lot of Wall Street firms. Let me explain it to you. So, first, there are firms or hedge funds, let's say, because everybody talks about hedge funds. So let's talk about them for a minute. There could be a hedge fund that is a long-only hedge fund. That's the only thing they do. They just go long, and they could be equities-based, right? So they cannot short, they cannot go long, they cannot go short. Some of them could be restricted to a certain sector. So, for example, some would say, okay, we can only trade in the technology sector. They cannot trade on anything else that might be a better sector for that quarter or the year or anything like that. They just have a focus on one. Some of them don't allow shorting because because obviously of the unlimited risk, because the market could go really high. Some of them might not use leverage at all. And some of them have certain restrictions when they trade. And many of them are registered, right? So as registered entities, with the self-regulatory bodies or the federal bodies, they're under very strict rules of how they can trade. So the process of changing methodologies or changing environments or anything like that, it has to be done not only on the legal level with consulting internally, but it also has to be structurally where they all have to adapt it to it, and it takes some time. That's why investing in any fund, regardless of the skills that they have, the profit is never guaranteed. On the other hand, you as a trader, you have a lot more flexibility in terms of your decision making because you're an individual. So you can trade, let's say in my area of futures, so you can trade Nasdaq futures. You can trade crude oil futures. You can be in bonds. You can be in currencies. You can be in all the sectors. And you're under no obligation to perform. So hedge funds obviously have shareholders and they have to perform in a certain level. So I think they have those kind of expectations. And nobody expects from you to produce anything. So you're not under pressure to trade. If you think the environment is not right for you, you just don't trade in that environment. You don't have to assume risks every day. You can examine different methodologies and you can move from short-term trading to maybe medium-term trading. Or maybe you can trade Some markets you can trade and hold a position for an hour. In some markets you may hold it for 15 minutes and for 4 hours. And don't take for granted that this kind of flexibility exists on every institutional level. So it's not a good idea to approach a strategy with some sort of how should I say, where you need anger management, where you mad at Wall Street, are you mad at brokers, you mad at institutions, or anybody else for that matter, as a narrative that says that they're going to fail you as a trader. So essentially it will come from them, some sort of action that is underlying in the background to sabotage your efforts as a trader. Every single fund out there tries to do the same thing that you do. They try to maximize on profit. That's exactly what they do. Now, some of them have very good skills, quantitative skills, risk management skills, organizational skills. But guess what? This is something that took them time to acquire. It's not because they graduated from some sort of elite school, and just because they have quantitative methods, it guarantees that they will make a profit. It does not. They have basically maybe a better way starting out because they're quantitative and they can develop a method. But don't think for a minute that they don't need to exercise the same type of risk management that you need to exercise, such as cutting your losses short, and at times you have to maximize and trade in environments more that might make your method profitable. I just wanted to mention in the meantime, and just throw a disclaimer out there, that there's a substantial risk of loss in futures trading, and past performance is not indicative of future results. We have seen in the marketplace an environment where there were some stocks, for example, that caused some hedge funds losses, and everybody's cheering for it. I have no opinion on the matter, but I will tell you this: if you are trying to find those markets, trying to guess which one will be the one that would send some fund bankrupt, this is more gambling than anything else. This is not trading at this point. It's just pure gambling, because people will try to maximize on a position, whether through an asset such as a stock, or they might go all in on the NASDAQ futures or anything like that. And in the long run, you have to ask yourself if this kind of behavior is consistent. Whether this kind of, well, I should rephrase it. Whether this kind of behavior would bring to consistency in trading. And the answer is no. You cannot be consistent applying this kind of a method, trying to pick winners in sectors or in certain futures just on a hunch of where it's going to go next. You really have to apply your discipline as a trader, as a self-directed trader. Take decisions that pertain to you and only to you. And that way you develop independence away from the crowd. Personally, I think, and this is just my opinion, that because today it is easier for individuals to connect on the internet, whether through forums, social media, video applications, and I think they will only expand. If you think where we came from, we have Twitter today that people communicate with one another. We have some Reddit where huge forums people communicate. People read comments that are on YouTube. People might even post comments to this video. So there's this entire interaction that consistently kind of affects us. And I feel that in the last year, and especially since COVID, has been us versus them. And you should change it to you versus you. Look at your skills and basically where you're at. And if you're a beginner, trade slowly, develop a method. Nothing is wrong with it. Again, nobody expects you to produce anything. Your goal is to develop a method. Your goal is to develop discipline. Your goal is to develop size that you should trade according to your skills, according to your and according to your tolerance. So what do I mean by that? If you're a quantitative guy, you have some sort of mathematical skill. If you don't have quantitative, maybe you can use simple chart analysis. But it will all boil down to the story you tell yourself as a trader. If you tell yourself the story that it's you versus Wall Street and you have no chance, then don't trade this market at all. Any market. If you're in the market and you're going to try, like I said, guess which market will be explosive in the long run, you will not make money. That's my opinion. You might be able to pick a few winners here and there, but in the long run, and that is a maybe question, right? I'm not even saying that even that is possible because they're so random, those explosive moves or on days or anything like that many times it just moves very fast and everybody joins and then it just stalls. It doesn't do anything. So, and then it might go down or go up, whether you're short. So again, the bottom line that what I'm trying to say is that don't act on impulsive moves in the market that affect your impulsive behavior. It will always boil down to your decision making and trade with things that you feel comfortable with. The other thing is this: funds compete for customers' assets, whether it's high net worth individuals or whether it's institutional money, and they have a competition between them. Obviously, they want to succeed in attracting the best money out there. What I mean by best money is more money. You don't have that pressure. You're not raising money from the public, or if you're not licensed, you shouldn't. But you have the ability to sit there and say, okay, how do I want to develop my strategy? So it's only you with the lossless variables. So just remember, you as a self-directed trader still have a lot of advantages over Wall Street as an individual trader. And again, I just want to remind everybody, please trade risk capital. Don't be impulsive with money you can't afford to lose. First, take care of your livelihood. Make sure you have shelter, food, and everything else. And it will also, in my opinion, will help you trade better because you're not under pressure. That's it for now, guys. Let's start the weekend. And again, I wish you all a great weekend. Just a little promo for our platform for Optimus Flow. Please let us earn your business. We would like to earn your business. Give Optimus Flow a chance. It's a great platform that has the ability to trade from the charts, from the dome. It's free, so take advantage. And I think you'll enjoy it very much. Besides the functionalities, the risk management on it, and the charting and so forth. And we would love to earn your business if you call us at 1-800-771-6748 or look at our site. It's optimusfutures.com, and our local number is 561-367-8686. And that's basically it. So all the best, and I wish you a great weekend. Take care. Bye-bye.